Hello, I'm David Russell, VP of Content Strategy at TradeStation in Chicago. I'm a specialist in the U.S. stock market with over 20 years of experience covering it as a journalist and analyst, and I'm here to help you trade it more effectively, no matter where you might be. This presentation is not an offer or solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including to, but not limited to, Hong Kong and Japan. Active trading is not suitable for everyone. Options trading carries a high degree of risk and is not suitable for all traders. Please read the disclosure information in the PDF handout available on the TradeStation website for more. Okay, so like Daniel said, we had a nice pullback here in the S&P 500. Now, wanted to first quickly tell everyone, if you go to the Monex Australia website, which is monexsecurities.com/AU, and you go here to Insights, you will find right here a summary of this webinar, Navigating the American Markets, live from Chicago. And these are the main ideas and main points we're going to be kind of walking through. Last week, we were looking at the S&P 500, and we said that it made sense to be looking for a pullback to between 2850 and 2800. And pretty much today, we went right down to this level at 2801, I think, was our low. One of the bigger sell-offs, that we've seen in a while. The market had been very complacent, up very steadily for about 4 months, and then we come into the month of May, and the selling really started. Now, what's interesting here is that a lot of good news has been priced into the American market at this point in time. When you look at a lot of the sentiment, by the way, we were looking at the TradeStation platform as a sister company, Monex Australia. This is the actual brokerage I work for. I'm in affiliation with Monex, but I wanted to just show this because this chart was what we had showed of the S&P 500. This is the main index we want to look at. We had pointed out at the time when you were looking at the broader market that a lot of good news had been priced in. My point of view, one of the things I always try and do when I look at the market, and I try to identify what are the news events that are coming up that are good or bad, and then have they been priced in. And at a certain point in time, good economic news had been priced in, a dovish Fed, low interest rates had been priced in, decent earnings had been priced in, and a lot of good news had already been acted upon. It was already in the rearview mirror, which puts you in a special situation because then suddenly something can come along and it makes it even more aggravated in terms of the response to it. So the market was already kind of peaking out at a level. Last week we were kind of saying that the RSI was weak. Certain momentum indicators were weak. I did not really expect the sell-off to be this fast, but I was saying that momentum was stalling, and when things start to stall, you kind of have to just look for where is the support. It's like a balloon in the air that loses its helium and then it starts falling. It could fall 10 feet or it could fall 1,000 feet. You need to look, where is the ground? And in this case, the ground we were looking at was right around 2,800. Why did we say that number? Well, at the time, it was pretty much similar to a level where we had late February, early March. It was near a bottom from back here in late March, but then also it was a very important line back here in the third quarter in mid-October, early November, and then early December, right around 2,800. But now we have pulled back to that level, and I think now's the time that a great deal of negativity has been priced in. And now it makes sense to be watching and waiting for things to hold, and then leaning more on the side of expecting more of a sort of rebound. And I think it's interesting here that when you look at this, we had kind of pointed out that this is a common pattern: the 50-day moving average rising above this 200-day moving average. And at the time, it was followed by a nice kind of upside. Over the longer term, when this pattern happens historically, and I've written about this on the TradeStation website in late March at the time it was happening, but when this pattern happens, it tends to be followed by continuation to the upside, based on historical patterns. I think 7 or 8 times out of 10 in the last 30 years when this happens on the S&P, it doesn't mean it goes straight up, but there is much more of a likelihood of a kind of continuation, or at least a probability based on the history. So if we look in the last week, we pretty much see a complete and total sort of risk off, people shedding all kinds of things from the market. The only things that really went up a little were like gold miners and a very select number of relatively obscure things, and things like utility stocks. But at the end of the day, this was a complete and total risk off sort of trade. Everything associated with China and emerging markets got destroyed, not surprisingly. What's also interesting is if you look, semiconductors, we had said last week, semiconductors, chip makers, that was an area of vulnerability with the uncertainty about China, and that's exactly what happened. If you look at this index, which is the Philadelphia Semiconductor Index, SOX, it has now basically erased this entire rally from April, and it's pulled back really aggressively. A lot of this was very much overbought. You know, semiconductors in China are very unclear. It's a very convoluted sort of thing. And when you see a pullback like this, you know, it can be like, wow, that looks like a great level. It's a nice pullback to this old high. And you can make that argument. But at the same time, maybe it needs to test this low, or maybe it needs to dig back down deeper to these lows. See, the problem with something like this is when this short-term momentum turns bearish, it's extremely difficult to really know where support is. You have to watch the support to kind of stabilize. At this point in time, a lot of hope was priced in. So I remain looking at semiconductors here, just thinking that a lot of things could happen, but we have no edge in our favor. So we're going to be looking at some things that maybe do have more edge in our favor. But something like semiconductors here are a complete kind of just whipsaw, you know, based on what happens with China. It's interesting if you look at the history in the last week, only 100 companies in the NASDAQ 100 index, I believe only 4, maybe 5 of them have a positive gain in the last week. The only major sector in the United States that went up was utility stocks, which are usually viewed as a sort of safe haven. Now, I just think when you look at this, this is a normal sort of risk-off sort of scenario. But I do think it's also interesting if you want to look at something else. 2 other areas that look of interest to me in a good and a bad way. Home builders. Now this is, ITB. This is going to be one of the things we want to look at. This is an exchange traded fund that tracks the housing market. But what's interesting is home builders barely went down this week. Now there's some data coming out later this week. Now the American housing market, you know, it's infamous for what it did last decade, but a lot of water is under the bridge. A lot of things have kind of improved since then. So I want to just kind of point out that this is an interesting area right now, because I think one of the takeaways we're going to get from this situation with the trade war is going to be lower interest rates. And when you have lower interest rates, that is also, you know, a positive for, you know, for housing. So I think this is it's interesting to see the relative strength of the home builder index. Just kind of didn't even make a low, you know, under this level from just a couple of weeks ago. It just kind of hung in there. That's a sign of relative strength, and I think that's something that stands out. On the other hand, last week we were warning about the drug maker stocks, the pharmaceutical stocks, and this just keeps getting worse in the United States. If you look at what's been happening with these, there's a company called Teva Pharmaceuticals. It's actually an Israeli company, but it's heavily an American company that got partially acquired by this, you know, by an Israeli company. But it's an old company called, you know, Bar Labs, which is a huge generic American drug maker. Now, a lot of people from other countries might not really understand the American healthcare situation because it is pretty strange compared to other countries where our insurance system works. But there's a lot of companies that have what they've done is they've always thought they can raise prices for drugs, and now they can't. And for various reasons, they were able to kind of working with some very complicated kinds of marketing relationships with insurance companies and pharmacies. They were able to push through higher prices, and then they borrowed a bunch of money to leverage it. And it worked for a long time, but in the last 6 to 8 months, this entire thing has been unraveling. It has not gotten as much attention as it possibly should, but a lot of major pharmaceutical companies in the United States, CVS Health, Walgreens Boots, these companies have gotten just destroyed. And we see this trend continuing. Last week, we were adamant about avoiding pharmaceutical stocks, and then we just saw more problems. Here's a company. This is a company that's been involved in, you know, pushing opioids, which is essentially this kind of like almost an illegal drug situation. And, you know, these companies now are starting to use the bankruptcy word. They have a lot of debt. They were pricing in price increases that they are not able to support. They borrowed money assuming they could raise their prices. So this area is continuing to weaken and struggle, and I want to just point that out. A lot of these pharmaceutical companies, the entire American healthcare sector right now has a lot of problems and sharks and vultures all around it circling, and we need to just be careful. I think it's important just to take a step back. You can make fundamental arguments about a lot of companies in this sector, but this is a big sector that sentiment has really gotten worse, and the problems just keep popping up. So I wanted to just kind of remind people of that, is that the worries we had about pharmaceutical, it continues to worsen. So now let's take a look at some of the things here on a brighter note. Let's take a look over here on the Monex Australia platform. And I want to take a quick look at the ITB. And now this is interesting because this holds a series of American home builders. And I think when you look at something like the ITB, wait a second, let me, I'm going to restart I opened this up a little while ago. I'm sorry, I probably should just restart this. And very quickly, I want to, I should have done that previously. It's like when you get something ready, you're using a computer, you log into a website, and then it logs you out. It was probably 5 or 6 hours ago that I opened that and I was ready for the webinar. So here we go. All right. So I go to my, I have a list here set up. So I go to my, my watch lists. And then right here, I've established watch list. This is watch list 3 with my, kind of ideas I have for today. So we look at ITB. Here's a 1-year chart. We can add moving averages to it. And this is a 50-day moving average. And what's interesting about this is there is a price range here around 38 that it kind of tried to hold last year, and it really cratered down through that level. So what's interesting about this is that there has been a lot of evidence of the housing market in the United States coming back. There is data coming out this week on Thursday for the United States, Thursday morning, which will probably be very late Thursday evening for you guys, or maybe sometime in the midnight going into Friday morning. But there's housing starts and building permits. But at the same time, we have a situation right now when it was interesting, if I look at the global economic situation, where you have Malaysia and the Philippines both cut interest rates last week. We had some very low inflation reading in the United States. And at this point in time, that all argues in favor of lower interest rates. The housing market is also something that has a very strong American concentration. And it's an area that has been, where you look, there's no excess of inventory. There's no pressure of pricing going down. If anything, you have an area that has been depressed for years now, that is just coming back to life. There's not a lot of speculation or a lot of froth in it. So housing right now, the thing that really stands out to me is just the absolute relative strength, the fact that this has managed to hold in there while the rest of the market has gotten hammered recently. And when we look at the overall economic thing, like I was saying, I think it's interesting, the Chinese trade numbers that came out last week for April were really bad. They were like almost barely a third of what they were expected to be in terms of their trade surplus. I saw some reports about Chinese loan growth in the month of April really missing estimates. At the same time, we're seeing bankruptcies increase. Now, I'm not an expert on China and I'm not an economist, but I do know about the credit market. And when you start to see credit growth slowing at the same time bankruptcies are picking up, that is the sign of a weakening in a distressed situation. Now, I'm not sure how dependent China is on borrowed money, but the point is that when you have economic activity, you have factories, you have consumers and jobs all tied up with borrowing money, and that's all tied up with exporting largely to the United States. You see those trade numbers weakening. You see the banks weakening in terms of their lending. You see bankruptcies rising, and then you see the United States saying, you know what? We're just going to raise tariffs on you anyway. If you're a Chinese factory now and you're deciding, do I spend a bunch of money to buy another piece of machinery? Do I build my inventories? Do I, have more assets? Let me just fix this here. The answer very quickly becomes, maybe I'll wait. And then the one guy waits, the next guy waits, and it just trickles down. And next thing you know, you have a generalized slowing. That seems to be happening in China now. We're seeing the Chinese currency weaken significantly. Now, how far it goes isn't clear, but what is clear is that we have a direction now. But as that happens, what else does that do? It drags on interest rates. And it's going to be one of these situations where investors are going to be looking for stocks. We still have an economic expansion in the United States. We have record low unemployment, the lowest since 1969 in terms of unemployment. All those things are positive. All those things are positive right now for the United States. And housing is a very clear way to play that. Now, some people are saying that some of the housing things with China, where there's certain products that are imported from China, it's especially true for things like faucets and like nice fixtures and things. Some of that stuff has been outsourced to China. The nice thing about ITB, or the interesting thing about it, is it's basically home builders, literally companies. They're companies like Lennar, LEN, and companies like Pulte Home. These are companies that physically build structures and build houses. So I wanted to point this out. This is a real area of strength. Home Depot reports is a huge retailer of home goods, of hardware and lumber and things like that. They report earnings next week. But I was thinking about this, and the concern of something like that is you have earnings uncertainty. You also have the risk of something like some kind of tariff squeeze. So focusing on the builders themselves is a way to really hone in on this part of the economy that is pretty interesting. Now, as we also keep looking for things that are going to, benefit from, low interest rates, there's another company that I bet very few people in Australia have heard of, but it's interesting, which is called Crown Castle. They own towers for mobile and cellular communications. Now, this company has, there are 3 companies that do this business, and this is the second biggest of the 3. The biggest one has not pulled back as well. So but these 3 companies, it's AMT, CCI, and SBAC. These are wireless towers. These companies are just in a general growth sort of phase. If you look at a longer term chart of some of these companies, you can see that they had a period of consolidation followed by a breakout here not that long ago. So these companies are in a long, steady uptrend. And if we go back here to our daily chart, you can see that this is holding its 50-day moving average. With interest rates easing, these companies are technically in a part of the market that is called real estate investment trusts, which generally do well when interest rates are lower or interest rates are not shooting up. And when you look at the situation now with, like I said, the central banks overseas, when you look at the situation with the market getting hammered and volatility going up, it's hard now to really imagine a situation where interest rates start to go up quickly in the United States. And that's going to make investors looking for things like, Crown Castle, things like home builders. So this is another kind of part of the market. What's also interesting is the United States. I don't know where you guys are in Australia with this, but the United States is starting to build 5G networks, these faster wireless, cellular phone, mobile networks. And that's going to be something else that is going to trickle through and give more growth opportunity to something like CCI. When you drive down a highway in the United States, you see these towers. You go around and there's pretty much no more land in the key areas that are populated. There's 3 companies that control pretty much those areas, and CCI is one of them. So this is why I wanted to look at this stock today. It's an interesting one, I think, to consider. Now, remember, if you have any questions, go ahead and share them. Let me see. Daniel, do we have any questions? I'm trying to look here. I don't see any yet, but I also might not be looking in the right place.
Nothing at the moment, no.
Okay.
Yeah, I'll let you know.
Just let me know if anything does come through. Great. So basically, the other thing that I did want to mention is a company that is more cyclical, but it is also not something that is especially vulnerable to China. This is a company called Honeywell. It's actually in the Dow Jones Industrial Average. It is a very, large conglomerate, but it is not a publicly facing company. It's not a company like General Electric or even a company like Caterpillar, who most people know. Honeywell makes a series of industrial things, a lot of focus on things like aerospace, certain things involving building and manufacturing. But there's a lot of stuff here that this company has been really honing in on. Aerospace is a big part of it, but they're also involved in a lot of improvement in the American factory sector. Different kinds of like machinery that like conveyor belts and things that manage warehouses. They're in that space, and that space has been growing quickly. Another time, I did an article last year. It's fascinating that the number of people working, for example, now in warehouses is greater than the number of people working in like major like department stores, because we have things like Amazon and all this online shipping. There's this huge shift toward a new kind of transportation, new kinds of order fulfillment. And it's interesting that Honeywell is kind of dug into that area. Honeywell is heavily in aerospace. It's been doing well. Now you look at a stock like Boeing, we were kind of saying, last week that Boeing is a company that it's just a pawn in this trade war between Trump and China. Boeing is one of those stocks that is just a huge risk on that factor. But a stock like Honeywell is in its own special spot. So if we look at Honeywell here, what's interesting is this was an old high right around 165. And that's exactly where it's holding. Now, if we look at a shorter term chart, we have some candlesticks here. This big price gap up, this was a good earnings report. It had a good earnings report, and now it's pulled back to that, that level, and it's a high from last year. So Honeywell is just another company that they have beaten estimates quarter after quarter. They don't have a lot of, Chinese exposure per se. Most of their global exposure is to Europe. It's not to China. So Honeywell is, to me, a fascinating company. I like it when I see companies consistently beating estimates like this company has. It's kind of under the radar, but you see companies like this sometimes. It's a major blue chip company. It's in the Dow Jones Industrial Average. So, you're looking at a stock that is very sort of, solid on that front. So as we just kind of look at the S&P overall, like I said, I want to take a look back just really quickly here to see what the futures are doing. And I'm going to look at this really quickly on the TradeStation platform. Now, remember, it's about 8:20 right now in New York time. It's 7:20 for me in Chicago. And this is the futures of the S&P 500. And if you can see, we are kind of just holding around this 2,800 level. If we look on like an hourly chart, you can see that this has been a very strong sort of sell-off at this point in time. And, a lot of these things, when it really comes to this sort of drop, it is a point of something being oversold. Now, I did actually a podcast that is going to be live tomorrow, or probably, the next day for you guys. But the key thing is that these tariffs are not a particularly large number when you really look at it. It's less than $50 billion overall. We've lost over $1 trillion of market cap in the United States. So my point is that a lot of this sell-off was very much the result of the technical conditions that I had cited last time. A lack of catalysts, overbought condition, slowing momentum, and no clear support really. I mean, 2850 was something of a level to watch. If we look back here to the cash index, there was this level at 2850 from, here in late March. And we did try to defend it here for a short time. If you look back, last week we tried to hold 2850, but it wasn't, as clear of a line. 2800 has been a very big deal on this index for a long time. In fact, if you look even all the way back here to March of 2018, this level at 2800 was a big deal. It was, it was a peak here. I mean, this is a big line going across the chart, and we've pulled back to it now. So at this point in time, we've priced in a lot of fear and a lot of negativity. Apple took an absolute beating. But the question now is, we still have essentially a pretty strong economic environment in the United States. There's not a lot of evidence. People keep saying that this trade war is going to hurt business, and we just don't really see it. The other thing I think that's interesting is our inflation is so low in the United States that even if prices go up for certain things, it's going to be hard to really say that, that this is going to create a big inflationary problem. Quite honestly, the Federal Reserve would probably be very happy if this created an inflationary situation, but it doesn't seem like it is. The other thing to remember is that this is deflationary for things like agriculture and commodities and fuel. So all that stuff kind of undermines the tariff hike. It's a big unsettling thing. People thought that a deal was going to be made. We were very clear that we thought people were way too complacent about this. So I think at this point in time, all that's panned out, but now we have to just go back to the fact, looking at the chart, that we're looking at a strong economy, we're looking at interest rates are going to stay low, and we're looking at a significant pullback following a chart pattern that has a strong historical pattern. It's a pullback to a level that has been relevant. We've written about 2,800 for a while. If you actually dig into my blog at TradeStation, and a lot of that has been, over there at the Monex website. So at this point in time, I think we have to realize we've priced in a lot of fear. And now the question is really, will people just keep staying out of the market? Will they refuse to buy a stock like a Honeywell? Will they refuse to buy a lot of other companies just because of, these tariffs with China? And I think that's actually the thing where now we've priced that in, and now we could be seeing more of a sort of move in the other direction. So those are the main things I wanted to talk about. Last week, some of the stocks we mentioned, they just kind of struggled along with the rest of the market. I can just very quickly mention those. IWM is a broad index. It essentially dropped maybe a little bit more than the overall market. But I still believe when you look at this is something that has much more of an American exposure. At this point in time, the chart is just kind of drifting here. But I wanted to just follow up with that. Progressive has done the best of these. This is an interesting name. It continues to hold in the low 70s. This is a very interesting company. It doesn't get a lot of attention globally, but it is one of the best insurance companies in the United States, or at least one of the fastest growing and best performing. The other one was Snap, which has pretty much just followed the rest of the market, hasn't done terrific. So I did want to just kind of follow up with those. Those are some of the ones that I had mentioned from last week. But like I said, the bigger point I really had was just the situation of the overall market. I also think it's interesting just to kind of think about an adage that one of my old bosses once told me, which is lows are seldom made on Friday. The market does not bottom on a Friday. So when there's fear and danger, very often that's going to come through on Monday morning. So it's just a little adage that once again was proven accurate today. So I wanted to just follow that. And if we have no other questions, it's been great talking to everyone. Do we have any questions, Dan?
No questions so far. If anyone has a question, you can raise your hand. I think we're good, David.
Great. Well, it's good talking to everyone. Thanks for joining us. We'll be back for another one of these webinars Monday of next week, or Tuesday morning of next week. And it's great talking to everyone. And thank you, Dan.
Thank you, David. And for all those watching, we hope you enjoyed this webinar. You can trade all these securities and many more on our platform. And currently, we're offering a free brokerage on all of our international markets. It's not just the US, but you can trade shares in China, Hong Kong, Japan, and many more, all with free brokerage. So if you're not already a client, you can get our website at www.monexsecurities.com.au for more information, or give us a call on 02-9103-9602. Thank you.